training tonight is about bonds. Bonds. What is a bond? A bond is basically when a government or a corporation comes to you and they offer you a piece of paper, and on the paper it tells you that they want to lend money off you. It's an IOU, and if you lend a certain amount of money to them, they will give you a fixed interest rate. And that fixed interest rate, written on the certificate, tells you how long you will earn that interest for, over what period, and at the end, 5 years, whatever it is, you will get your principal amount back, as well as having had all the interest rate during the period that you have lent the government or the corporation that money. So what happens, I mentioned terms. Terms, they call them short-term bonds, which means that you're investing between just 1 to 5 years. Medium-term bonds, between 5 years and 12 years, and then they even have bonds going as far as 30 years. So you can go long-term bonds from 12 years to 30 years. There are a mixed bag of types of bonds depending on exactly what they're offering you. So there are fixed, which is the straightforward one. It gives you a fixed interest. It returns the principal at maturity. That's very simple. They have floating rate notes, which gives you some opportunity to make money on the initial invested money. There's zero coupons, there's convertibles, the secured, where they're backed. You can sell your debt for possible stocks in some cases. That's secured against some asset. Junk bonds. Now, junk is exactly what it sounds like. It's more risky. Potentially, you can make a lot more on the initial amount you invested on a junk bond. So there's quite a variation across the board in the type of bonds that you can purchase. I mentioned the terms, the ratings. Fitch and Standard & Poor's, they come along and they say, well, that's a junk bond, so they give it less of a secure rating. If you've got a secure sovereign bond from UK, say, the UK government has never reneged on any debt, ever. They give AAA rated. AAA rated down to BBB rating is a good rating. D, then you're starting to get suspicious and be more careful about what you're getting into. Payment periods, the interest rate that they're going to pay you, they tell you right at the beginning on that certificate, they're going to pay you half yearly or annually. Alternatively, you can go with a group such as Fidelity or Vanguard, and they are experienced fund management groups who give you a combination of bonds. And they, in that type of bond fund, you can get paid monthly or quarterly. In other words, more regularly than going into a specific bond. Interest rate returns have, over the last 19 years in the United States, bonds, overall, the top sovereign bonds have beaten stocks 14 out of 19 years. This year, currently, the best selling asset in Australia is government bonds, and the best performing asset class in the UK, and bonds in the UK are called gilts, government bonds, they are the best performing asset class in the year 2016. So, who invests in these type of bonds? Bonds are invested normally by people who want a little bit more security. They know exactly what they're getting. It's written on the certificate. And they hold on normally at the lower risk end of their overall portfolio. And it just chips along and you get your returns. And at the end of maturity, you get your initial amount you invested, your IOU, you get it 100% return. So that basically is bonds in a nutshell, and they are well worth looking at as an investment asset class to invest in. Thank you very much.